Welcome everyone to the market update for the quarter ended 30 June 2020. I'm going to begin by taking you through market performance for the quarter, 1 year and 3 year. Then I'll discuss why the share market performance might have diverged from economic performance. At the time of our last update, we were still in lockdown, and this was filmed by our oldest daughter Nina, along with her support crew and sisters Juno and Katinka. During lockdown, we saw a lot of our Prime Minister Jacinda Ardern and the then relatively unknown Dr. Ashley Bloomfield, Director General of Health. Throughout New Zealand, cities took on the look of The Quiet Earth, a great post-apocalyptic science fiction film starring Bruno Lawrence. Terribly underrated if you ask me. Since then, things have gotten a little bit back to normal. We're back in the office for one, and we're seeing clients here on a regular basis. The nascent recovery that began in March also continued well into June. This slide shows the performance of asset classes that we utilise for the 3 months ended 30 June. What a recovery it has been. The top performer during this time period was Australian shares, where $1 invested at the beginning of the time period would have grown to about $1.21. In second place, standing out in red, is international shares hedged to the New Zealand dollar. $1 invested there would have grown to around about $1.18. This quarter had the rare feat of every asset class we monitor producing a positive performance. And it was a really good one. A 50-50 mix of shares and cash and fixed interest would have grown to a little over $1.08 during this time period. A great recovery and a great reward for those investors who stayed in their seat during the March quarter. But was that June quarter enough to make up for that negative March quarter over a full year? These are the same asset classes looked at over 12 full months, and the story's a little bit different. There's still some positive performers. This time the leader is New Zealand shares, where $1 invested for the full 12 months would have grown to around about $1.09. In a creditable second place tie are international fixed interest hedged to the New Zealand dollar and New Zealand fixed interest, which would have grown to just over $1.05. There are, however, still a number of asset classes that over 12 months delivered a negative performance, including a 50-50 mix of shares and cash and fixed interest, which would have declined ever so slightly to around about 99 cents. Not great. How about over 3 years? This is where that June quarter makes something of a difference. The March quarter still makes a big difference. It produces a steep drop, but over this 3-year time period, every asset class we monitor has delivered a positive performance. The leader, again, this time is New Zealand shares, where $1 invested 3 years ago would have grown to around about $1.55. The second place line on this chart is actually that 50-50 mix of shares and cash and fixed interest. That would have grown to around about $1.22. Notwithstanding that really pronounced negative March quarter, that return is actually around about the long run expected return for that mix of shares and cash and fixed interest. That's despite this time period including that significantly negative March quarter. That June quarter makes a difference. But why? Why was that June quarter recovery so pronounced, as the March one was negatively pronounced, even though the economic performance hasn't been as strong? The June quarter's economic performance, or GDP growth, has been negative. Pretty much in every economy around the world. Every economist on record that I could find is predicting a recession, which is 2 successive quarters of negative economic growth. And yet, the June quarter's market performance was really strong. Why have those numbers diverged? Broadly, 2 reasons: monetary and fiscal policy. The US Federal Reserve announced a $2.3 trillion US bond purchase program. They slashed interest rates by 1.5%. All of this was designed to promote financial stability and support businesses, support their ability to borrow and invest. The Reserve Bank of New Zealand slashed interest rates by 0.75%. We started from a higher point and announced a $30 billion bond purchase program. Central banks around the world did very similar things. Governments around the world announced massive fiscal stimulus packages. The economic impact of these will take some time to work through, but markets responded almost immediately. The things that ultimately grow share markets are companies, and companies felt safer to borrow, to invest, to grow as a result of these packages. And share markets responded to that feeling of safety immediately. Share markets have been around for around 400 years. They exist as a place for companies to raise capital, to invest and grow. They are the sum of those individual companies. They are, by definition, forward-looking. That means that sometimes they will defy our intuition and recover before economies do. Investors who responded to weak economic performance by selling shares could have cost themselves a lot of money. I hope that's not you. I hope that you were sensible, stayed the line, and kept a hold of your investments even during that discomfort, because you were rewarded. That remains our advice now. I hope you found this market update interesting. I look forward to updating you again at the end of the next quarter.